Whilst Western Europe struggles with low economic growth, Eastern Europe is booming. In the past 2 decades, Eastern Europe has quietly witnessed an economic transformation, with growth in living standards far outperforming the West. Estonia, Poland and Romania have all seen a near doubling of living standards. In the early 1990s, wages in the West were nearly 5 times higher than a country like Poland. But on current trends of economic growth, average wages in Poland could overtake the UK by the end of the 2030s. It's a really remarkable turnaround. Whilst the German car industry stutters, Poland has seen a near doubling in their car industry, which now accounts for 8% of GDP. What has caused this transformation in the East? And why is the West falling behind? One reason for higher growth rates in Eastern Europe is that in the post-communist system, there were many inefficiencies that gave room for easy productivity gains as firms learnt Western methods. However, as this productivity gap narrows, it means it will be harder to maintain this higher growth rate going forward. For example, 2023 was a difficult year for the Polish economy, with high inflation curtailing economic growth. But since October elections last year, renewed confidence in the private sector has seen the World Bank revise upwards its forecasts for economic growth to 3% in 2024, 3.5% in 2025. And this is much more optimistic than the miserable growth rates predicted for countries like Germany, France and the UK. Since joining the EU in 2004, Poland has more than doubled its national output. The success of EU membership explains why support for the EU is so high in countries like Poland. Membership of the EU saw 3 main benefits. Firstly, trade with Europe increased. Secondly, it became a more attractive place for foreign investment. And thirdly, Poland has become one of the biggest recipients of EU funds. In 2021 alone, it received a net gain of €12 billion. Now, in recent years, concerns over judicial independence and rule of law saw the EU actually place a temporary freeze on some COVID recovery funds. But in allowing a renewal of judicial independence under Donald Tusk, EU recovery funds were unfrozen, and this will help the economy. However, more than EU funds, what has really boosted the Polish economy is a growth in the inflow of private investment by multinational firms. They see Poland as an attractive destination. The stock of foreign direct investment in Poland reached over €400 billion in 2018, or 40% of Polish GDP. Poland is one of the largest recipients of foreign direct investment. But why? Why has Poland attracted so much? Firstly, wage costs are still lower than in places like Germany and the UK. Secondly, Poland is one of the hardest working economies in the OECD, an average 1,766 hours per year, compared to say 1,300 in Germany. Poland also has good levels of education, with 42% of young workers having higher education. This is above the European average. Also, since the Ukraine war raised fears over the West's reliance on China, Poland has become seen as a partial alternative, low-cost manufacturing, but with the advantage of geographical proximity. In the aftermath of Brexit, some British firms are even producing in Poland to get around the loss of the single market, an irony there. Also, one of the striking features of Polish economic growth is that it has corresponded to a decrease in inequality. This shows a 26% fall in levels of inequality, showing that growth has been broad-based. In 2005, 45% were at risk of poverty. By 2022, that had fallen to 16%. In fact, across Eastern Europe, levels of inequality are amongst the lowest in the world. By contrast, Brazil has a Gini coefficient of 50. Maybe this is all a legacy of the communist system, but equality is quite strong in Eastern Europe. In the early days of joining the EU, Poland suffered something of a brain drain, with young entrepreneurial workers leaving to seek higher wages in Western Europe. In 2011, this reached a net 2 million net migration. This loss of skilled workers adversely affected the economy. But in recent years, the effect of Brexit in the UK, plus a narrowing of a wage gap, has seen many of these young workers return to Poland, and net immigration has significantly fallen, showing that Poland is now an attractive place for its own most ambitious workers. Since 2022, Poland has also seen the biggest influx of Ukrainian refugees, bolstering the labour force and GDP, though also putting pressure on education and housing. 41% of the nearly 1 million Ukrainian refugees are of school age. The Ukrainian conflict has also heightened tension in Eastern Europe, put pressure on Poland's continued trade with Russia in things like agriculture. But also it has encouraged multinationals to reshore manufacturing closer to Europe rather than more risky supply chains in Asia. In 2023, partly as a result of a mortgage subsidy, partly due to growing population, Poland saw the fastest growth in house prices in Europe. But despite the recent boom, Poland still has one of the most affordable housing markets in Europe. It's helped by a relatively lower population density, and also the economic growth and rising wealth has seen a construction boom. Many new houses been built to keep up with demand, and this has enabled Poland to avoid the worst excesses of the housing market you see in the Anglosphere. Strong economic growth can also cause a virtuous circle. High growth has caused lower unemployment. It's near full employment at the moment. Also, it's helped reduce levels of government debt, one of the lowest rates in Europe. And this is despite significant government investment in building a major increase in the road network, a key factor in Poland's trade. Relatively low borrowing also meant the new government had some fiscal space to have tax cuts and higher spending to help recover from a difficult 2023. And this virtuous circle that we see in Poland is almost the opposite in Western Europe, because in Western Europe a long period of low growth has caused low investment, low confidence, and it's also led to higher debt, tax as a share of GDP rising. But the Polish economy is not without problems. It was particularly vulnerable to a loss of Russian gas, seeing inflation rise 15% in 2022. In 2023, energy prices rose 23%, the third highest in Europe. Now, Poland may be catching up with Western Europe, but that pace of narrowing has started to slow. Also, the convergence between Poland and the West reflects as much economic weakness in West as it does strength in Poland. Around 28% of Poland's exports go to Germany, and so an economic slowdown in the main trading partner will definitely hold back Polish economic growth. Western Europe has really struggled in recent years due to low confidence, ageing population, low investment, and Germany in particular was particularly affected by high gas prices we saw recently. Also, Western Europe, as members of the euro, have pressure towards fiscal austerity, which has hampered a lot of public investment, and this is a factor behind Germany's low growth rate. Now, in theory, as a member of the EU, Poland should move towards euro membership too. But seeing the difficulties faced by countries like Greece, Italy, Portugal may be a cautionary tale, because once in the euro, Poland would lose its monetary independence and exchange rate. And there's no guarantee that interest rates set by the ECB would be suitable for the Polish economy, which is currently doing very different to, say, Germany and the Netherlands. However, at least for the moment, delaying the decision seems to be accepted. A key feature for the Polish economy is what's happening in Germany. This video suggests Germany's crisis shows no signs of abating and could get worse, so do check it out.